Jerry Flum, CEO of CreditRiskMonitor.com, trades on the OTCQX under the symbol CRMZ. Bob Power, Vice President of Corporate Services at the OTC Markets. Jerry, welcome to the OTC Market here in New York.
Thank you, Bob.
Jerry, CreditRiskMonitor.com upgraded to the OTCQX in July of 2012. Can you tell us a bit about the company and a bit about your role as CEO?
Okay, well, I'm going to stick with the company more than my role. We compete with Dun & Bradstreet, so we do corporate credit analysis, not analysis of people, but corporations. We analyze 58,000 companies around the world in real time, and we have data on about 3 or 4 million private companies. But basically, our strength is public company credit analysis. When you walk into a store and you buy a TV set, you're going to walk out with that TV set only if you pay for it. But in business-to-business transactions, people ship goods and then they bill the goods. So I can send $500,000 worth of widgets to company X. I ship the widgets and then I bill them, 210, net 30, or some other terms. And so what we do is we analyze whether that company you've shipped to is a good credit risk. Can they pay you? And can they pay you in a timely manner? It's very critical for working capital. So we're a very counter-cyclical business. And in today's world, people should be looking for counter-cyclical investments because the world is a little upside down.
Jerry, what differentiates CreditRiskMonitor.com from other companies that do credit risk analysis? And what in particular is your strategy for growth?
Well, our difference is that we have broad coverage of public companies in huge detail, and it's all in real time, and it's the most inexpensive service that corporations can buy. It's an all-you-can-eat service. And we have a frisk score, which we developed over the last 8 years, which predicts bankruptcy, and we've statistically tested it. We've done it over 7,000 companies, and it has predicted bankruptcy in 95% of the cases within 12 months. In other words, the important thing for a credit manager or a purchasing manager is when will that company go bankrupt? They have to do business with companies pretty much up to the end, not like investment people who want to get out early because they're trading pieces of paper. Credit managers are sending goods, and if they ask their sales team not to sell to a company way too early, they're going to lose a lot of business before that company goes bankrupt. So the timing of the bankruptcy is very, very important. It's not only calling it, but in a timely manner. That's our basic strength. If I was an investor, what makes it an important investment is that we have a very, very strong balance sheet. We have no debt, and we have cash equal to 80% of sales. We have a reoccurring income stream because we are in a subscription agreement, and we have a re-sign rate of 90%. We have right now about 40% of the Fortune 1000 among our subscriber base, and no one company represents more than 1.5% of sales.
So your subscriber base is global?
Yes, it is, and it's in every industry, and it's in every part of the world. No one industry and no one country.
Jerry, what are the major factors affecting corporate credit risk today, and what is your viewpoint on corporate credit debt throughout the world?
Well, actually, there's really one overwhelming metric that people should pay attention, and that's the amount of debt in the world at the corporate level, at government level, and personal level. Today, it's higher than it was in 2007, 2006. So actually, the world is in worse shape than it was prior to the last crash. That's the overwhelming metric people should pay attention to. And we analyze all corporate credit risk. And so we're right in that spot where people need to look. And that means we're counter-cyclical. And that's an important ingredient for investors.
So as a counter-cyclical company, when credit markets get a little more questionable, the role of your company gets enhanced.
Well, it's a little different than that. We're not, our clientele, for the most part, are not investment buyers of debt. Our market are credit managers and purchasing managers. What happens to them is as the debt starts to contract, the amount of business that everybody has diminishes. It's called actually a depression or a recession. And that causes credit risk to increase at corporate levels, whether they will get paid and whether they'll get paid in a timely manner. getting not paid obviously is a critical factor, but also not getting paid in a timely manner can take the working capital of most companies and make it very difficult. So that's makes us a very important ingredient and very critically important in bad economic times.
Jerry, what else should investors know about CreditRiskMonitor.com, trades under the symbol CRMZ?
Well, I'm going to answer that as the hat I used to wear as a hedge fund manager. What makes a great investment and a great story? The things that I looked for as a hedge fund manager was reoccurring income streams, very critically important. 2, a super strong balance sheet. Most small companies fail because they're undercapitalized. We have reoccurring income streams. We have a subscription business, so they reoccur. We have a 90% plus re-sign rate. We have cash equal to 80% of sales. We have no debt. We have a business that is quite large around the world. The need for credit, extension of trade credit, it's a $1 trillion business. And so our major competitor is Dun & Bradstreet, and we are dramatically lower in price than they are. And we also are specialized on the public companies, who are, for the most part, analyzed very differently than private companies, which is a real serious strength of D&B. Interestingly enough, public companies represent probably 30 to 40% of the GDP revenue numbers that one talks about, so it's a huge risk. And if you're going to analyze public companies, you want to analyze the financials, and you want to analyze the customer base that they have, and you really don't want to analyze as much about their trade receivable payments, whether in fact they're paying their bills or not, because public companies can disguise credit difficulties by paying their bills timely and then go out of business.
Understood. Well, Jerry Flum, CEO of CreditRiskMonitor.com, thank you for visiting with us today at the OTC Markets.
Thanks.